This is the Building Wealth Podcast with your host, Stephen P. Sitkowski.
Well, welcome everybody. Stephen Sitkowski here. This is my Building Wealth weekly podcast. We may end up doing them a bit more often, just kind of depending. We're getting a lot of folks that are listening, which I'm happy about. I love the teaching, but the only way to be a teacher is you've got to have the student. So I'm happy to have you with. It is the 29th of June. Absolutely spectacular day here. I hope it's great wherever you are. Markets are making a bit of a comeback after kind of the drubbing that we had last week. You know, we kind of yo-yo around what's going on with Iran, which causes oil prices to yo-yo, which causes investor sentiment to kind of move up and down. And, you know, the markets don't like uncertainty. The markets want to be able to have a pretty clear idea of sort of how things are going to go. There's always variables, but there should be certain limitations to those variables. But, you know, it's always something. If it was easy, everybody'd get rich. So I did have a request from one of you asking about kind of my parameters for stocks for doing covered calls. So I will cover that for you near the end today. So as always, we got a whole lot to do. If you want to contribute either a question or a subject that you'd like for me to cover, you see my email for those of you who are on your computer. If you're in audio mode only, my email address is Steve Sitkowski, Steve, S like Sam, IT like Tom, Kowski @gmail.com. Just a little bit of my background. I've been working with people and their money now for some 45 years. So if this is your first time in meeting me, by the way, welcome. During that period of time, I've trained somewhere between, best estimate, 1.5 and 2 million people. So I've been at this for a long time. I intend to do it for a lot longer. Absolutely enjoy the fact that, you know, for me, watching what's happening in the financial markets is very interesting. I like it. The average person does not. I think it's because the average person doesn't really understand what they're hearing. So what I do is I try to take all of that and turn it into everyday language. Just, you know, talk to you person to person, assuming you're not an investment expert, because if you are, probably wouldn't need anything that I have to say. So I don't want to use the term dummy it down. That's a little insulting, but I try to simplify it and I try to make it actionable so that you can have something to legitimately take away and go, hey, I now know something that I didn't know before. As a reminder, everything that we do here is for educational purposes only, should not be intended as investment advice. So from time to time, I will comment on a particular stock, tell you that I think this represents good value. I'm not suggesting that necessarily you run out and buy it. I don't know. Do you have the money? Does it fit within the rest of your investment portfolio? Does it meet with your risk tolerance, etc.? We're just having a conversation. It's up to you to do your own analysis on that. So what's moving the markets? By the way, let me give you an update. Now, this is Monday when I record these, and I realize people will look at them, you know, all through the week. But kind of the headline here, Dow jumps more than 200 points as U.S. Iran halt hostilities. It's actually up 317 points. The S&P 500 is up 1.07%. The Nasdaq is up 1.83%. The Nasdaq 100, so that's big tech, is up over 2%. The Russell 2000, those are small cap stocks, they're actually down about 0.5%. So the Strait of Hormuz, as we understand it, and we get a different story every day, very candidly, I'm frustrated with this story because you never know what's really going on, you know? And it's like when you cry wolf so many times, but presumably the strait is open again. Ships are moving through. Fantastic. That should lower oil prices, lower gas prices, lower the cost of a whole lot of things. Most everything gets shipped somewhere. So when you raise energy prices, that becomes a problem across the board. How long this is going to last, I can't tell you. I'm not even going to guess anymore. There were times when I thought I had a sense of how things were going there. I don't. I've lived through the war's been declared over, and the next day people are shooting at each other. We have a ceasefire. The next day people are shooting at each other. We had a deal supposedly a week ago. The markets responded favorably. Oil prices came down. And then I understand that Iran is attacking ships. I don't know what to believe. But for now, apparently, um, things have calmed down. We'll see how long it lasts. Nasdaq was down 4.6% last week. Took a drubbing. I think that there's a fair amount of, in fact, I know there's a fair amount of fear out there, and people are worried about what's going to happen next. Geopolitical tensions, the fact that you've got some stocks that are up 2, 3, 400%. How far can they go? So at the least little crack in the armor, you start to see some profit taking. And it was the high flyers that got hit the worst in many cases. So now the market is up 2%. So we've made back almost half of those gains. So that's great. Key jobs data, and I'll go through this with you, is going to be coming out this week. The JOLTS number, those are job openings. We always have initial jobless claims on Thursday. And I think we've got some new job creation numbers that'll be coming out. I'm, pardon me, I'm starting to see a little weakness in the job market. And I've seen that now for 5 or 6 weeks. Nothing critical yet. It has not moved the needle on unemployment, but if it continues in this direction, it will. So I'll be keeping an eye out on that for you, and I'll be reporting next week. 10-year Treasury is below 4.5%, which is great. 4.374. Lower oil prices, lower interest rates. So that's great. Market is comfortable between 4 and 4.5. It loves below 4. Above 4.5, not so much. Above 5 becomes problematic. Oil prices today are up slightly at $70.28 a barrel. But you know what? We're down from $111 a barrel. I'll take it. This is for West Texas Intermediate crude. So the scoreboard when it comes to sectors for last week. So the S&P was down 2.42%. Healthcare has been making a run. It was up 7.32%. So that's considered defensive. Utilities up 3.22, also defensive. REITs up 3.15, also defensive. And consumer staples 1.69. This is where people run when they're nervous about the market. We call it a risk-off environment. What's risk on? Technology, right? Tech was down 5.4%. Communications down 3%. Discretionary down almost 2.5%. So clearly, the fear index, yeah, it was up. People responded very predictably. Market breadth. So I go through this with you pretty much every week. There's two things that I look at: number of stocks that were up versus down on both the New York Stock Exchange as well as the Nasdaq. Then I look at new highs versus new lows on both. Now, for such an awful week, when you look below the surface, it wasn't that bad. On the NYSE, there were actually more stocks up than down. 1,548 were higher, 1,285 were lower. So what does that tell you? The stocks that were lower were much lower. But when you look at new 52-week highs versus 52-week lows, we had 337 new highs, 243 new lows. That's great. On the Nasdaq, we had more stocks that dropped than went up, but not by a huge margin. 2,453 were higher, 2,742 were lower. But look at new highs versus new lows. 745 hit new 52-week highs, 648 52-week lows. So by 100, we had more stocks hitting new highs. What does that tell you when the Nasdaq was down so significantly? It tells you the stocks that were down big, right? Because they had made these big dramatic moves to the upside. So when they pull back, they tend to pull back more significantly. Last week's heat map, I'll describe it for those of you who cannot see it. Basically, it plays out the way the sectors played out. We see a whole lot of red with tech and communications. So NVIDIA down 8.62%. Broadcom and NVIDIA sort of move in lockstep, down 11.26%. Texas Instrument down 11.6%. Marvell 14%. Qualcomm down 16%. Oracle software continues to get pummeled, down 19%. Palantir down 12%. Now, a stock that's been ripping higher, two of them, Seagate Technology down 16%, and Western Digital's had a fantastic year, down 21%. All right, so what was up? Pretty much everything in healthcare. Lilly up almost 10%, J&J up 11.5%, Merck up 13%. So a lot of double digits. Utilities were higher. So that's kind of the lay of the land. Very different today. So spending on data center construction, it is just going up, 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 up. It is now over $4 billion. It'll continue to rise. So I read somewhere that electricians who are working on these data centers, their wages are up 6.7% year over year, which is about double the wage increase for the average worker. I'm telling you, if you're trying to coach a young person on what to do, you either have them go into a trade or become an expert on AI. Because if you don't have some physical trade that you can perform that AI can't replace, or really understand AI to help a company utilize it better, you might as well, be the beta repairman or the guy who's selling IBM Selectrics. You're going to be out of date. So start coaching your young people, right? Get them thinking, what is the marketplace going to look like 10, 15, 20 years from now? Make sure they've got a saleable skill. Consumer sentiment has gotten markedly better. So this is a survey that gets done out of the University of Michigan. Everybody's kind of down in the dumps in May. Now we jump back in June, get this war handled. You'll see that go up even more. Market sentiment. So this was measured on June 24th. So this was before a lot of the pullback, but boy, did it improve. So on June 17th, the percentage of independent investors who predicted that over the next 6 months the market would go higher, they're at 36.6%. Well, on the 24th, they were at 44.9%. And the percentage of folks that were bullish over that week period dropped from 39% the previous week. The bullish was 47.7, then dropped to 39.4, and on the latest reading at 36.1. So people are definitely feeling better. After next week or last week, I think you'll see a bit of a pullback on this. Fear greed index. So this measures emotion. This is what we call soft data. So it'll run on a scale from 0 to 100, right? If people are euphoric, 100. If people are just completely despondent, 0. It never hit 0 or 100, not that I've ever seen. Right now we're at 26. We are deep into fear. So this gets updated daily. So it's not like investors are walking around going, happy days are here again. They're like, I just got done taking my my dog to the vet. I've got a Cavapoo that's 15 months old. And he walks in with his tail wagging, but as soon as the vet shows up, he's nervous. I think that's where investors are. Investors, much like my puppy, hey, don't hurt me. Don't stick me with anything. He did have to get his vaccinations brought up to date. Was not thrilled. Just like the market right now is a little suspect. Future of interest rates. How are those looking? Well, it's looked worse, a month ago, but it still doesn't look great. We're not going to get a rate cut. So throw that out. The question is, will we get a rate increase this year and when? So right now there's a 70% probability that interest rates will remain the same at the next meeting, which is July 29th. September 16th, as of now, there's a 62% probability there'll be a 0.25% bump in interest rates. Now, I listen to a number of analysts, those who I respect. There's a bunch of them who believe that if oil continues to come down, and given the fact that President Trump now has an appointee as the Fed chair, that the Fed may hold the line on interest rates. I would say if interest rates or if oil prices come down and the job market continues to look a little soft, then I think there's a decent chance. But if the job market firms, because inflation is just too high, the Fed's going to have to address that, and their primary tool is by raising rates. So we'll have to see. I'll be checking with that week to week and reporting to you. I'd say there's probably a 65% chance that between now and the end of the year, we get a 0.25% increase. Sector performance year to date. Now, this is interesting. A month or so ago, the lowest performing sector was healthcare. And now look, it's in the green. I'm telling you, investors are fickle. That's why you got to continue to check in. I've been saying that financials are going to make a comeback. They have a little bit, but they're still in the red year to date, which I don't understand. They're selling at low multiples. They pay a good dividend. They will have their day. Um, the big winner, energy. That's because of the war. Throw that out. Next is industrials. That's AI, data center construction. Um, so energy is up 19% year to date, industrials 17%, technology 13%, reads 12%, materials about 11%, consumer staples 9, utilities 8, healthcare up almost 4, communications basically break even, discretionary down 1.5, financials down 1.66. The market, the S&P 500 is up 7.79%. This is only half the year. So, I mean, that's pretty impressive. You look at tech is up 13% for half the year, extrapolates out to 26%, which is about how tech earnings are growing year over year. Some good stuff. All right, let's take a look at the news of the week, things that you should be watching for. So today, June 29th, nothing. And really, I focus on the things that could influence the market. On Tuesday, the 30th, we got the Chicago Business Barometer coming out. That's worth a look. So we'll sort of see what the lay of the land is for business owners. Also, on Tuesday, the jobs opening and labor turnover survey. So that's going to give us a feel for the strength of the labor market. If that's weak, it's bad for the economy, but it bodes well for the possibility of holding interest rates, which is what the market would prefer. On Wednesday, we get the ADP National Employment Report, how many new jobs are created. We get the manufacturing PMI, that's Purchasing Managers Index. So we'll see how robust manufacturing side of things are. On Thursday, the weekly jobless claims, they will come out. That's been rising. We get the employment report, the unemployment rate forecasted to come in at 4.3%. Average hourly earnings, month over month, expected to come in at 0.3%. Year over year, expected to come in at 3.5%. And nothing on Friday. So pretty eventful week. You're going to want to keep an eye on the financial news. For sure, there are some things that could absolutely move the market. All right, let's check the charts. So every week at this time, we check in on the S&P 500, SpaceX, by the way. So its first published price when it went public, it had an IPO price of 135, but it came out at 150. It's about where it came out, 156. And that's because it's up 3.5. So on a percentage basis, it's basically just gone up nothing, which does not surprise me. Came out hot, went way above 200, and it's come back down to probably where it ought to be. I still think it's a little pricey. Let's take a look at the SPX. This is the S&P 500. So as we examine the chart, again, if you're an audio only, I'll describe it to you. So I'm looking at a 6-month chart. I have a 50-day moving average on this chart is represented by a yellow line. So just generally speaking, we see where the market moved sideways for a couple of months. Then the war broke out, right? Beginning of March. The market fell significantly. Ceasefire was announced end of March. Market kind of moved up from that point, we hit a high of 76.20. And then the P stocks broke down. We came down, kissed the 50-day moving average and bounced, challenged the 50-day moving average again and bounced. And now we are, at least so far on the day, we are above that 50-day, which is a good sign. The 50-day is sloping up, which is a good sign. We have formed a bit of a wedge pattern, which is typically a breakout pattern, which means we can expect either a big move to the upside or the downside, probably influenced by some of the events over the next couple of weeks. So overall, I am cautiously bullish. How's that sound? And then the Qs. So this is the Nasdaq 100 Trust. 100 largest companies traded on the Nasdaq. Looks very similar. It is a little further above its 50-day moving average than the S&P. It's up 2.34% on the day, but I would be also cautiously bullish on this. Let's take a look at the VIX. This is the volatility index of the S&P. The VIX, among other things, it measures volatility, but indirectly measures fear. When the market goes down, the VIX typically goes up and vice versa. So today it's down 3.53%. The VIX will run in a range between 13 and 25. Recently, it hit a high of 23. It's now back down to 1776. Was a very good year. So we're kind of in the mid-range, maybe slightly below average. 50-day moving average is where? Yeah, almost exactly where we are right now. So things are looking pretty good. I'm going to put a 200-day moving average up here just for the hell of it. I want to see how we compare to that. 200-day moving average is at 1864. So we are below the 200-day. So that's good. People are generally feeling okay, but we can't discredit that fear greed index either. So again, if there are topics, questions you want to send to me, those go to Steve Sitkowski at gmail.com. Love to make you part of the program. So on closed trade ideas of the week. So this was actually, these were two trades that we closed the previous week. Every week, my partner and I put out generally 2 to 4 trade ideas. The one on Caterpillar was a call spread. So a spread trade is where we simultaneously buy an option and sell an option on the same underlying stock. So it is a mildly bullish strategy. The expiration was June 18th. Made a 22% profit on that one in 9 days. And Western Digital, I was talking about how it pulled back. Well, before it did, we were in there crushing it. We made 48.2% in 10 days. So if you understand spread trades and options, and you would like to get our trade ideas of the week, simply go to tradeidea.com. There's a little video that you can watch that describes the service, plus the track record for the last 3 years, which I got to tell you, I think in our worst year, we made money on 92% of our trades. It's been pretty remarkable. All right, so at your request, let me talk a little bit about how I select candidates for covered calls. Now, early on these podcasts, I did a class on fundamental analysis, and I'll repeat that at some point. So fundamentals are where you grade a company based on its numbers, right? How is the business performing? So my preference in identifying stocks for covered calls, number one, I like large cap stocks. So these are companies that have a market cap. So market cap is you take all of the number of outstanding shares, multiply it by the price per share. There's your market cap. So I like 10 billion or more as my market cap. Next, we want solid fundamentals. So we want companies that are growing earnings, growing revenues, expanding market share, expanding profit margins. And also, when I look at them on a chart, they don't give me any indication of being overbought, right? And kind of the telltale signs of that, an RSI above 70, that's a relative strength index. A stock that's made a parabolic move, watch out for, it's not sustainable. Or a stock that gets, on a relative basis, too far away from its 50-day moving average. Those are all stocks that are going to pull back. So, but I'm looking for good fundamentals where the stock is fairly priced. I want to pick stocks that are mildly bullish, right? You can make money on a covered call if a stock goes sideways. You make a little more money if it goes up a little bit. If it goes up a lot, that doesn't really help you. The reason is, in a covered call, you've sold somebody the right to buy your stock from you at a certain price. So let me give you an example. I have a stock trading at 100. So I sell a 101 strike call. I've sold somebody the right to buy my stock from me for $101 a share. And then the stock jumps to 110. Well, guess what's going to happen? Stock's going to get purchased from me at 101. I didn't get the benefit of that appreciation. So that's why I said mildly bullish works best. When I'm looking at charts, I want something with low to moderate volatility. Stay away from the stocks that make big moves to the upside or to the downside. They don't help you. I already explained why it didn't help you if it makes a big move to the upside. Why doesn't it help you if it makes a big move to the downside? Well, when does it ever help somebody to own a stock that goes down a bunch? Never. So now your stock is falling faster than you can generate income by selling calls against it. And dividends on these types of stocks are a plus. And let me explain why. When people get nervous about what's happening in the market and they start to sell, guess what they sell first? The typically riskier investments, the growth stocks, they tend to be more speculative. What do they sell last? Generally, stocks pay a dividend because they've gotten accustomed to that dividend, right? And they want to keep collecting it. So that is kind of my formula. And maybe what I'll do for you for next week, I don't know, we'll see what your feedback looks like, is, give you a list of a handful of stocks that I think are good covered call candidates. So there you have it, sports fans. Awesome being with you again. I hope you enjoyed that and learned some things. And have a great rest of the week. I'll be back with you then. Until then, be safe, be blessed, and bye for now.